Welcome to the Deep Dive, where we really try to get to the heart of complex topics. Today we're tackling Bitcoin. And wow, what a topic, right? It sparks such strong reactions.
It really does. You hear completely opposite things.
Exactly. On one hand, you hear things like, it's somebody's freedom, it's somebody's liberty, it's somebody's silent protest. Powerful stuff.
But then, just as loud, you hear the other side. It has been hijacked by opportunists, con artists, right, scammers. It's quite the split.
It really is. So our mission today is to dive into Bitcoin's whole journey. It's the oldest, probably the most famous crypto out there. We want to trace it from those, radical anti-establishment roots.
Yeah, the early days.
To what it is now, this complex global thing. We'll look at the big promises versus the real-world impacts from tiny towns to central banks, just trying to figure out its actual role in finance today.
And that's so relevant for everyone listening, isn't it?
Absolutely. I mean, for you, listening right now, understanding Bitcoin, it's not just about maybe investing. It's about getting a handle on where money itself might be heading. With inflation, digital everything, shifts in financial power.
Yeah.
It's all connected. So let's get into it.
Okay, so where do we start? I think the identity crisis is key. What is Bitcoin? Currency, commodity, just a big speculative bet. Its identity seems to have shifted so much.
That's a great starting point. It began back in 2008 with that white paper from Satoshi Nakamoto, whoever that is.
Still a mystery.
Right, proposing a peer-to-peer electronic cash system. Came straight out of that Cypherpunk movement, didn't it? All about privacy, censorship resistance, basically sending money online without needing a bank.
Yeah, that was the dream.
But looking at it now, with all the volatility and complexity, was that vision ever really practical? Or was it just, a beautiful idea that couldn't quite work in reality?
That's a really good question. And honestly, if you look at how it's actually used for buying things day to day, the data suggests, well, not really. The European Central Bank, for instance, they didn't mince words. They called Bitcoin transactions cumbersome, slow, and expensive.
Ouch.
Yeah. The network just can't handle many transactions per second, not compared to Visa or MasterCard. And settlement. It can take 10 minutes, sometimes longer. That just doesn't work for buying coffee, right?
Not really, no.
And let's be honest, its anonymous nature, well, pseudo-anonymous, it unfortunately did become popular for illicit stuff. Ransomware, darknet markets, that definitely hurt its reputation as just cash.
Okay, so if the digital cash thing didn't quite pan out, what happened? Did it just fade away?
Not at all. The narrative just pivoted big time. It started getting framed as digital gold.
Ah, right. The store of value argument.
Exactly. The idea became, okay, maybe it's not cash, but it's scarce, only 21 million coins ever. It's durable. It's sort of politically neutral. So maybe it's a hedge against governments printing too much money, debasing their currencies. That fixed supply is key to the digital gold idea.
So it wasn't just a marketing spin. It was like finding a new purpose for it.
Pretty much. And if you look at the numbers, purely from an investment return perspective, that digital gold idea, well, it's actually performed incredibly well.
How so?
We're talking extreme outperformance over several years. The compound annual growth rate, over 80% for Bitcoin. Compare that to, say, the S&P 500 at maybe 13%, or actual gold around 7%. It's just huge.
Wow. But okay, the volatility. Everyone knows Bitcoin is volatile. Wild swings.
Oh, absolutely. Extreme volatility is the phrase. Massive drops, 80% or more have happened. But here's the interesting thing, that volatility has generally been decreasing over time as the market matures. Sometimes it's been comparable to, like, big tech stocks, believe it or not.
Really? Like a Netflix or something?
Yeah, in certain periods. And when you look at risk-adjusted returns metrics, like the Sharpe ratio, the Sortino ratio, they basically ask, are you getting paid enough for the risk you're taking? And for Bitcoin, the answer's generally been yes. A lot of that volatility was actually upside volatility.
Okay, so potentially high returns, but still, it feels like a casino sometimes, doesn't it? This speculative arena. Doesn't that clash with the whole stable store of value idea? Especially for, regular people.
That's the core tension, isn't it? The whole crypto space, Bitcoin included, has definitely attracted, let's just say, less scrupulous actors.
Yeah.
Opportunists, con artists, scammers.
Like the FTX thing.
Exactly. The collapse of FTX was a massive blow. Sam Bankman-Fried convicted on multiple counts of fraud, conspiracy, stealing billions from customers. It highlights this huge irony.
What's the irony?
Well, the Bitcoin network itself, the protocol, it's incredibly secure, it's decentralized, it's never actually been hacked. But most people don't interact with the network directly. They use these centralized exchanges, like FTX was, or Binance, or Coinbase.
Right, like regular online accounts.
Precisely. And these exchanges basically recreate the traditional banking system on top of crypto. So you get the same old risks-backed counterparty risk, single points of failure, the very things Bitcoin was supposed to get rid of.
That really is ironic. So moving from these big market dynamics, let's zoom in on a specific place where Bitcoin was meant to make a real difference on the ground. El Salvador, and specifically El Zonte, or Bitcoin Beach.
Ah, yes, Bitcoin Beach. A fascinating story. It's this small coastal town, pretty impoverished, maybe 3,000 people. A lot of them didn't have bank accounts.
So ripe for a new financial system.
That was the idea. It started with this anonymous donation, apparently quite large, from someone in the US. The condition was use the money to create a local Bitcoin economy.
Okay, how did that work out?
Well, it funded community stuff, a charity called Hope House, doing education, keeping kids away from gangs. And importantly, it helped build new, better homes for over 120 families. They took out loans, supposed to be repaid in Bitcoin.
Wow, so real impact.
Initially, yes. There's this story of Maria Aguirre. She sells pupusas, a local food. She got into Bitcoin early with this project, saw her holdings shoot up when the price went crazy, up to $60,000.
Amazing for her.
It was. But then the price crashed by over 2/3, and she lost a lot. It just shows how that volatility, it cuts both ways, especially for people without much cushion.
Yeah, that's tough. And then the whole thing went national, right? President Bukele.
Right. In 2021, President Bukele made Bitcoin official legal tender, first country in the world. They rolled out this state-run digital wallet called Chivo, gave every citizen $30 worth of Bitcoin to get started. It was a huge, bold move.
How did that national experiment go? Was it Bitcoin Beach scaled up?
Not exactly.
Yeah.
Frankly, the national rollout,
Yeah.
it was pretty much a failure.
Oh, why?
Well, first, there were immediate street protests. Lots of people were skeptical, maybe suspicious. Polls showed almost 70% of Salvadorans were against the law. Then the Chivo wallet itself was just plagued with problems.
Like what?
Technical glitches, servers crashing, reports of identity theft where people's $30 bonus was stolen, problems processing payments. It was messy.
So people didn't use it much?
Barely. By 2024, surveys found something like 92% of Salvadorans just weren't using Bitcoin for transactions. And remittances, a huge deal for El Salvador's economy. Only about 1% came via crypto.
Wow. So what happened to the law?
International pressure mounted. The IMF especially. They basically said, get rid of this mandate if you want our $1.4 billion loan. So in January 2025, the government amended the law. Bitcoin was no longer mandatory for businesses to accept.
So the big national dream kind of fizzled out.
Pretty much, yeah. The grassroots thing in El Zonte had some successes, but scaling it nationally just didn't work.
And you mentioned something about unintended consequences back at Bitcoin Beach itself, from all the fame.
Yes, this is the really sad part in a way. All the global media attention on Bitcoin Beach, plus the national law, it triggered this huge speculative real estate boom right there in El Zonte.
Ah, so property prices went up.
Way up. More than doubled. Luxury developments started popping up, asking over $1,000 per square meter. And the result, the original residents, the very people the project was meant to help, started getting priced out, or worse.
Worse how?
Investigations found at least 25 local families were facing eviction. Their land was needed for a new government-backed project called the Bitcoin Beach Club de Playa.
Oh, wow. So the project aimed at inclusion actually ended up pushing people out.
It's a really tough outcome. A stark reminder of how these things can go wrong.
Okay, let's shift gears a bit, away from the social and economic towards another huge issue surrounding Bitcoin, the environment. That proof-of-work system, it uses a ton of energy, right?
A staggering amount. I mean, the scale of Bitcoin's energy use it's arguably its biggest vulnerability, maybe the main barrier to wider acceptance.
Give us some numbers. How bad is it?
Well, the estimates vary a bit, but the Cambridge Center for Alternative Finance puts its annual electricity consumption around, say, 190 terawatt hours.
Yeah.
That's similar to the entire country of Thailand.
Thailand, wow.
Yeah, and the carbon footprint.
Yeah.
Maybe over 100 million tons of CO2 a year, comparable to Belgium.
That's massive. What about per transaction?
That's where it gets really stark. A single Bitcoin transaction can use the same amount of electricity as an average U.S. household consumes in over a month.
A month? For one transaction?
Yep, and its carbon footprint is like over 1 million times that of a single Visa transaction. Plus, there's the e-waste issue. The specialized computers used for mining, these ASICs, they become obsolete quickly. We're talking maybe 35,000 tons of electronic waste generated annually.
That's hard to wrap your head around. And this isn't just an abstract global number, right? It affects real places. You mentioned Plattsburgh, New York.
Plattsburgh is a classic case study. It's a small city, about 20,000 people. Back in 2018, a big Bitcoin mining company called CoinMint set up there. Why? Super cheap hydroelectric power, like less than 2 cents per kilowatt hour.
Okay, so they moved in.
And started consuming a huge amount of power. At peak times, that one facility was using up to a third of the entire city's electricity supply.
Whoa, what did that do to everyone else?
Well, Plattsburgh had this allocation of cheap hydropower. CoinMint used it all up. So the city's utility had to buy more expensive power on the open market to meet everyone else's needs.
Meaning higher bills for residents.
Exactly. Residents, local businesses, everyone saw their electricity bills go up significantly. Plus, there was noise pollution from the industrial fans. And the promised benefits. They didn't really materialize. CoinMint only created about 10 local jobs, and since their profits were in Bitcoin, not much tax revenue flowed back into the community.
So what happened? Did the city just accept it?
No, the mayor at the time, Colin Reed, he's actually a professor of banking and sustainability. He led the charge. They brought in regulations making CoinMint pay for the extra costs they caused and put a temporary ban on new mining operations.
And CoinMint.
Faced with higher costs, they basically packed up and moved a lot of their miners elsewhere, left the city dealing with the aftermath.
So we hear this argument from the industry about green mining, right? Using stranded energy or excess renewables that would otherwise go to waste. Is there anything to that?
Look, it's a nice narrative, but you have to question the primary motivation. Miners are fundamentally driven by the cheapest power they can find. Profit is king.
Not necessarily green power.
Not necessarily. If the cheapest power comes from, say, an old coal plant that's been converted to run on natural gas like the Greenidge generation plant, also in New York, they'll use that. And that plant actually increased its emissions to power Bitcoin mining. Plus, proof of work needs power 24/7. Constant, reliable power. Intermittent renewables like wind and solar, they often can't provide that alone. So miners frequently end up drawing power from the main grid, which is often powered by fossil fuels, just to keep things running smoothly.
So the link between price and energy use is still there.
Absolutely. It's fundamental. When the price of Bitcoin goes up, it becomes more profitable to mine. That incentivizes more miners to join the network or existing ones to expand. More mining means more energy consumption. It's a direct link, pretty much unavoidable with proof of work as it is. The green claims often feel more like, well, greenwashing.
Okay, so after discussing all these challenges, the volatility, the regulatory failures in El Salvador, the environmental cost, this next part feels almost paradoxical.
How so?
Bitcoin, this thing born out of anti-establishment, cypherpunk ideals, it seems like it's now being embraced by the very financial system it aimed to bypass. Wall Street is getting involved. How does that even work?
It is fascinating, isn't it? And maybe one of the biggest twists in the Bitcoin story. But it's less about Bitcoin subverting the system and more about legacy institutions adopting the underlying technology blockchain for their own purposes.
Can you give an example?
Sure. Look at Société Générale, the big French bank. They have a subsidiary called SG Forge. It operates fully within EU financial regulations, MiFID II, MiCA, these comprehensive rules for markets and crypto. And what do? They issue digital native financial products.
Like what?
Things like digital bonds, tokenized assets, even their own stablecoin pegged to the euro, called EUR Coinvertible. They're using blockchain within the regulated system to make things like settlement faster, more efficient, more transparent, especially for institutional finance. It's evolution, not revolution, really.
Okay, that's using the tech. But what about Bitcoin itself being embraced? The spot Bitcoin ETFs in the US seem like a huge deal there.
Oh, the US spot Bitcoin ETFs approved in early 2024. That was an absolute watershed moment, a total game changer.
Explain what they are, exactly.
Okay, so a spot Bitcoin ETF is basically an investment fund, but it's regulated. And it trades on traditional stock exchanges like the New York Stock Exchange or NASDAQ. Yeah. Key thing is the fund directly holds actual Bitcoin.
So it makes it easier for regular investors.
Massively easier. Suddenly, anyone with a standard brokerage account or even a retirement account like a 401k or an IRA could get exposure to Bitcoin's price movements without having to deal with crypto exchanges, digital wallets, private keys, all that technical stuff that puts people off.
And the market reaction.
Immediate and huge. Billions of dollars flowed into these ETFs right after approval. That demand was a major driver pushing Bitcoin to new all-time highs. But maybe even more importantly,
yeah,
these ETFs were launched by giant mainstream asset managers. BlackRock, Fidelity, names everyone trusts. And they were approved by the U.S. Securities and Exchange Commission, the SEC. That gave Bitcoin a level of regulatory legitimacy it just never had before. It was like a stamp of approval from the heart of the financial system.
That does sound like a major policy shift in the U.S. then, especially compared to, say, Europe.
A definite pivot, yes. Yeah. For years, there was this regulatory hesitation, uncertainty, but then leading up to and following the ETF approvals, culminating in maybe a joint statement from the SEC and CFTC staff around September 2025, the tone changed.
How so?
The message became clear. Existing laws can accommodate trading these spot crypto products on registered exchanges. The rhetoric shifted towards empowering American innovation, becoming the crypto capital of the world. It marked a real divergence from the more critical stance you hear from, for example, the European Central Bank. Two very different paths emerging.
Okay, so we've got Bitcoin evolving from digital cash, failing mostly, to digital gold, succeeding maybe as an asset. We've seen grassroots adoption meet harsh realities, the environmental cost, and now this embraced by traditional finance. It feels like all of this has sparked a much bigger debate.
Absolutely. It's ignited this fundamental discussion, geopolitical, philosophical even, about what money is and what it should be in the future. It's like a three-way contest brewing.
And one of the main players pushing back hard against Bitcoin seems to be the European Central Bank.
Oh, definitely. The ECB has been running what you could call a counteroffensive. They are not fans. Their public statements are incredibly blunt. They've said Bitcoin's fair value is zero.
Zero, wow.
Yep. Called it a speculative bubble, the currency of crime, an unprecedented polluter. They see it as fundamentally flawed and potentially dangerous to financial stability and their own monetary control.
So if they hate Bitcoin, what's their alternative? What's their vision for digital money?
Their main strategic response is developing their own digital currency, a central bank digital currency, or CBDC. They're calling it the digital euro.
Okay, why are they doing that? What's the goal?
Well, officially, it's about preserving Europe's strategic independence and monetary sovereignty. They don't want the future of digital payments in Europe to be dominated by either decentralized crypto like Bitcoin or by big private US companies like Apple Pay or Google Pay or potential stablecoins from Meta or others. They want a state-backed digital option.
But CBDCs, they bring up privacy concerns, don't they? The specter of surveillance.
That's the huge counter-argument, yes. Because a CBDC is centralized by nature, run by the central bank, it could theoretically allow the government to see every single transaction. People worry about programmable money. It's like the government could send out stimulus money that can only be spent on certain things, or expires after a certain date. Or in more extreme scenarios, they could restrict certain purchases, or even freeze someone's funds entirely.
That sounds pretty different from Bitcoin's whole ethos of privacy and autonomy.
Completely different. It's the opposite philosophy, really. Now, the ECB insists they're designing the digital euro with privacy in mind, maybe aiming for cash-like anonymity for small payments. But there's a deep level of mistrust there from both sides. Crypto advocates distrust the state control, and the state distrusts the unregulated nature of crypto.
So, putting this all together, what does the future landscape of money look like? Is it Bitcoin versus the digital euro? Or something else? It sounds like we're heading towards a more mixed, hybrid future.
I think that's exactly right. It's unlikely to be just one winner takes all. We're probably looking at three distinct forms of money coexisting, competing, maybe complementing each other.
Okay, what are the three?
First, you'll have state money, primarily CBDCs, like the digital euro. These will be the digital equivalent of cash, fully regulated, centralized, and tools for governments to conduct monetary policy.
Number two.
Second is corporate money. Think private payment networks, PayPal, Apple Pay, and maybe regulated stablecoins like USDC or potentially others. These will also be centralized, regulated to some extent, run for profit, and they'll compete mainly on user experience and convenience.
Okay, state money, corporate money, and the third.
And third, you'll have decentralized money, where Bitcoin seems to be carving out its niche, not as cash, but as that non-sovereign, politically neutral store of value, a digital gold idea. It will likely continue to function as a speculative asset, but also as a potential hedge against the state and corporate systems for some people.
So different tools for different jobs, essentially.
Precisely. Each serves different needs for different users, and the balance between them will keep shifting based on technology, regulation, and, frankly, people's evolving ideas about what they want from their money.
What a fascinating, complex picture. We've really covered a lot of ground today. We saw Bitcoin's journey full of these paradoxes, right? Failed as cash, maybe succeeding as digital gold.
The dream of inclusion in El Salvador running up against displacement and volatility.
Yeah, the anti-establishment tech being adopted by Wall Street. And this digital asset having a very real physical environmental footprint.
I think the main takeaway is how much Bitcoin has changed. It started as one thing, this fringe idea, and it's become something else entirely, this increasingly institutionalized, non-sovereign, digitally scarce asset. More like digital gold for our time than a replacement for the dollar or euro. Its value proposition now seems rooted in that scarcity and its resistance to control.
So as we wrap up, here's something for you, the listener, to think about. What's the ultimate dilemma here for Bitcoin? Can its original revolutionary spark even survive this mainstream success?
Especially with regulators closing in, the environmental questions getting louder, and that constant tension between the pure decentralized ideal and what the market actually wants, which is often easy to use centralized services.
Right. And what does this whole battle over the future of money state versus corporate versus decentralized mean for your own privacy, your economic freedom? What about the global balance of power? And maybe most importantly, what role will you choose to play, or what systems will you choose to use in this complicated new financial world that's emerging?
Lots to think about there.
Definitely. Something to chew on until our next deep dive.